Central banks around the world hold huge stores of gold. That much is well known. But something quieter has been happening behind the scenes, and it involves silver. For years, silver has moved in ways that surprised many investors. It rises faster than gold in some months. It falls harder in others. Gold and Crest Finance has been watching this pattern closely, and the story behind it starts with the decisions made by the world's central banks. Central banks do not usually buy silver in large amounts. They mostly buy and hold gold. Yet their choices still shape the price of silver every single day. This happens because of interest rates. When a central bank raises or lowers rates, it changes how people think about money. It changes how much a dollar, a euro, or a yen is worth. And because silver is priced in dollars around the world, these changes reach silver markets almost instantly. This story began to take a sharper turn in 2025. Inflation stayed higher than many expected, even as central banks tried to control it. At the same time, interest rates in several countries stayed low compared to that inflation. This created what economists call negative real interest rates. In simple terms, money sitting in a bank account was quietly losing value. People noticed. Investors noticed. And many of them turned to metals like gold and silver to protect their savings. By 2026, this shift had grown into something much bigger. Silver prices moved sharply upward, catching many casual investors by surprise. Analysts point to a mix of reasons. Central bank policy was one major piece. Industrial demand was another, since silver is used in solar panels, electronics, and new technology. But the timing lines up closely with major meetings held by the Federal Reserve and other central banks, including the European Central Bank, the Bank of Japan, and the People's Bank of China. Why does this matter to everyday people? Because silver is not just an industrial metal. It is also seen as a store of value, much like gold, but smaller and more sensitive to change. When confidence in paper currency weakens, even slightly, silver tends to react fast. Gold and Crest Finance has tracked this connection for months, and the pattern keeps repeating. A central bank signals a policy shift. The dollar weakens or strengthens. Silver responds, often within hours. There's another piece to this story that many people miss. Central banks talk about inflation and jobs in their public statements. They rarely mention silver directly, yet traders and analysts read between the lines. When a central bank hints that it may cut rates or that inflation could run higher for longer, metal markets move before official numbers are even released. This is sometimes called market expectation, and it plays a powerful role in silver's daily price. The people affected by this story are not just banks or large investors. Everyday savers, retirees, and small investors are part of it too. Many of them hold silver coins or bars as a way to protect what they have earned. Others invest through funds that track the metal's price. When silver moves sharply, it touches their savings directly, whether they follow central bank news or not. Gold and Crest Finance believes this connection between policy and precious metals deserves more attention than it usually receives. It is easy to focus only on stock markets or housing prices when talking about the economy. But silver tells its own quiet story, one shaped by decisions made in meeting rooms far from the mining towns and trading floors where its price is ultimately felt. To understand silver's price today, one must first understand the tools central banks use to manage money. The most important tool is the interest rate. Central banks set a benchmark rate that affects borrowing costs across an entire economy. When this rate is low compared to inflation, holding cash becomes less rewarding. Investors then look elsewhere. Gold and silver are often where they turn, since neither loses value the way idle cash can during high inflation. The Federal Reserve remains the most watched central bank in this story. It holds regular meetings throughout the year, and each one is followed closely by traders. Interestingly, the Federal Reserve itself does not hold physical gold reserves in the way many assume. It holds gold certificates instead, while actual gold reserves are managed separately by the U.S. Treasury. This detail surprises many people, yet it does not reduce the Federal Reserve's influence on precious metals. Its policy statements alone can move markets within minutes. Other central banks matter just as much in this picture. The European Central Bank, the Bank of England, the Bank of Japan, and the People's Bank of China each set their own policies. When several of these institutions move in the same direction at the same time, the effect on silver becomes stronger. This is because currency markets react to these shifts together, reinforcing one another. When only one central bank moves while others stay firm, the impact on silver tends to be smaller and shorter-lived. There is also a newer development shaping the story. Silver has recently been classified as a critical mineral by U.S. authorities, including agencies connected to the Department of Commerce. This classification recognizes silver's growing role in manufacturing, clean energy, and defense-related technology. Because of this status, discussions have started around building strategic domestic stockpiles of silver, separate from its trading price on global markets. This step is different from anything related to central bank vaults. It focuses on supply for industry and national needs, not on backing currency. Even so, it adds another layer of importance to silver beyond its traditional role as a monetary metal. Golden Crest Finance has followed these policy discussions closely, noting that any new rules around domestic silver pricing could affect miners, manufacturers, and importers differently depending on where they operate. Officials have been cautious in their public language. Central bank leaders continue to describe their goals as keeping inflation stable and supporting employment. They rarely mention silver by name in official statements, yet analysts read carefully between the lines of every press conference. A single phrase suggesting rates may fall or that inflation could stay elevated longer than planned is often enough to move silver prices before the next trading day begins. Another detail worth noting is the gold to silver ratio, a tool many analysts use to understand how these two metals move in relation to each other. When this ratio narrows quickly, it often signals that silver is gaining strength faster than gold, sometimes right after a central bank meeting. When the ratio widens, it can suggest the opposite is happening. This ratio has become one of the clearest signals watched by those following precious metals markets today. Together, these rules, statements, and classifications form the backdrop against which silver trades every day. None of them mention silver directly in most cases, yet each one plays a quiet role in shaping investor behavior, currency strength, and ultimately, the price seen on trading screens around the world. The connection between central bank policy and silver prices reaches far beyond trading floors. It touches ordinary households, small businesses, and entire industries in ways that are not always obvious at first glance. Golden Crest Finance has examined these effects closely, and the picture that emerges is more complex than many headlines suggest. For everyday savers, rising silver prices can feel like good news. Those who bought silver coins or bars years ago hoping to protect their savings from inflation are now seeing that decision pay off. Retirees who added small amounts of silver to their portfolios often view this as a form of insurance, something that holds value even when currency weakens. For these individuals, the recent price movement offers a sense of financial security during uncertain times. However, the same price rise creates challenges elsewhere. Manufacturers who rely on silver for electronics, solar panels, and medical equipment now face higher production costs. Since silver plays a critical role in modern technology, sudden price increases can raise the cost of goods that depend on it. Small businesses in these industries may struggle to absorb these costs, sometimes passing them on to consumers through higher prices. This creates a ripple effect that reaches well beyond the metals market itself. There's also a broader economic angle to consider. When silver and gold prices rise sharply, it often signals that confidence in traditional currency is weakening, at least among certain investors. This does not mean a currency is collapsing, but it does suggest that some people are looking for alternative ways to protect their wealth. Economists remain divided on how seriously to interpret this signal. Some see it as a normal market reaction to specific policy decisions. Others view it as an early warning sign of deeper economic strain. The proposed strategic reserve status for silver adds another layer to this discussion. Supporters of this classification argue that treating silver as a critical mineral protects national industries and reduces dependence on foreign suppliers. They point to its growing importance in defense technology and clean energy production as reasons for building stronger domestic supply chains. From this view, setting price floors or encouraging local mining serves a long-term strategic purpose. Critics take a different position. They argue that government involvement in setting price floors interferes with free market pricing. In their view, allowing prices to be shaped naturally by supply and demand leads to fairer outcomes for both producers and consumers. They caution that policies designed to protect domestic mining could unintentionally raise costs for manufacturers who depend on imported silver, particularly smaller companies without the resources to absorb sudden price changes. Communities connected to mining also feel these effects directly. In regions where silver mining supports local jobs, rising prices and new strategic policies could bring fresh investment and employment opportunities. Workers and local business owners in these areas often welcome policies that strengthen domestic production, since it can mean more stable, long-term work. International trade adds yet another dimension to this story. Countries that export silver to the United States may find themselves affected by new pricing rules aimed at protecting domestic miners. Trade relationships built over many years could shift as a result, and other nations may respond with their own policy adjustments. This is not simply a domestic story. It carries consequences that reach across borders. Golden Crest Finance recognizes that no single perspective captures the full picture. Investors, manufacturers, policymakers, and everyday households each experience these changes differently. What one group sees as protection, another may see as interference. What raises value for one person's savings may raise costs for another person's business. This story is far from finished. Central banks continue to hold regular meetings throughout the year, and each one carries the potential to shift silver prices once again. Viewers who want to stay ahead of these changes should pay close attention to upcoming Federal Reserve announcements, along with statements from the European Central Bank, the Bank of Japan, and other major institutions. These meetings rarely mention silver directly, but as this series has shown, their language and decisions often ripple through the metals market within hours. One date worth watching closely is the potential decision tied to silver's classification as a critical mineral. Discussions around domestic pricing rules and strategic stockpiles remain ongoing, and any official announcement could bring new clarity to how this policy will actually work. Golden Crest Finance will continue to track these developments and share updates as details become available. There are also broader questions worth considering. Will other countries respond to new U.S. policies on critical minerals with their own strategic plans? Will industrial demand for silver, driven by solar energy and advanced electronics, continue to grow at its current pace? And how will everyday savers balance the appeal of silver as a protective asset against the practical challenges of buying, storing, and selling physical metal? These questions do not have simple answers, but they are worth thinking about carefully. For viewers who want to stay informed, a few simple habits can help. Following official statements directly from central banks, rather than relying only on secondhand summaries, offers a clearer picture of what is actually being said. Watching the gold to silver ratio over time can also provide useful context, since sharp changes in this ratio often reflect shifting investor sentiment. Reading updates from recognized financial and economic sources, rather than relying on rumors or unverified claims, remains one of the most reliable ways to separate fact from speculation. It is also worth remembering that no single video or article can capture every angle of a story this large. Central bank policy, industrial demand, international trade, and everyday household decisions all intersect in ways that continue to evolve. Viewers are encouraged to treat this as an ongoing conversation rather than a finished conclusion. Golden Crest Finance would like to know what viewers think. Do central banks fully understand the impact their decisions have on metals markets? Or is this connection something that deserves more public attention? Are strategic mineral policies a wise step toward protecting national industry? Or do they risk interfering with free and open markets? Sharing thoughts in the comments helps build a more informed community around these important financial questions. As the story continues to unfold, one thing remains clear. Decisions made in central bank meeting rooms, often described using cautious and technical language, continue to shape outcomes far beyond those rooms. They reach into retirement accounts, small manufacturing businesses, mining communities, and household savings alike. Understanding these connections does not require an economics degree. It simply requires attention, patience, and a willingness to look beyond the headlines toward the policies driving them. Thank you for following this series from beginning to end. Golden Crest Finance remains committed to bringing clear, balanced, and carefully researched financial stories to viewers who value honesty over sensationalism. For those who found this series helpful, subscribing helps ensure future updates on this story, and others like it reach you as soon as they happen. Until next time, stay informed, stay thoughtful, and continue asking the questions that matter most to your financial future.